Ever wondered how to trade wedge chart patterns in Forex? These intriguing patterns are more than just a geometric shape on your charts. They're a powerful tool that can help predict price movements. Imagine them as a pause button in the market, a moment where traders collectively take a breath and decide where to steer the currency pair next. Now, there are two types of wedge patterns, the falling and the rising wedges. Falling wedges form in an upward trend, their lines sloping down, signaling a bullish pattern. On the other hand, rising wedges emerge in a downward trend, their lines sloping upward, indicating a bearish pattern. But don't be fooled. These patterns can serve as either continuation or reversal signals. Intriguing, isn't it? Now that you know what wedge chart patterns are, let's dive deeper into how to trade them. First, let's focus on falling wedges. A falling wedge, as the name suggests, is a chart pattern that takes shape when price movements tend to converge downwards, forming a sort of downward sloping triangle or a wedge. So, what's happening here? Essentially, market prices are oscillating between lower highs and even lower lows, drawing closer together as the pattern progresses. Now, don't let the downward direction fool you. Falling wedges are often seen as bullish indicators. That's right, contrary to what you might initially think, a falling wedge can signal that an uptrend is just around the corner. How so? Well, the falling wedge signals a deceleration in downward momentum. It's as if the market is taking a breather, gathering its strength for a potential upward push. As the price action narrows, the bears, or those pushing the price down, start to lose their grip, and the bulls, those favoring an upward move, are getting ready to take over. But it's also worth noting that a falling wedge can serve as a continuation signal. This means it can form during an uptrend, suggesting that the upward price action will resume after a brief pause. In this context, the falling wedge can be seen as a period of consolidation before the trend reasserts itself. So whether it's a reversal or continuation signal, a falling wedge is a bullish pattern. It gives us a heads up that the bears are losing steam and the bulls are about to step into the ring. However, as with all chart patterns, it's crucial not to jump the gun. Patience is key. The confirmation of a falling wedge comes with a breakout. That's when prices breach the upper trend line of the wedge, signaling that the bulls have indeed taken control. Remember, a falling wedge signals that an uptrend is on the horizon. So, keep your eyes peeled for this pattern, and you might just catch a bullish wave before it surges. So, how do you trade falling wedges? Let's imagine you've spotted a falling wedge pattern during an uptrend. The first step is to wait. Patience is key in Forex trading. You need to wait for the price to break above the upper trend line of the wedge. This is your signal that the uptrend is likely to continue. Once the price breaks above the upper trend line, it's time to place your entry order. You'll want to enter a buy order, anticipating the upward movement of the price. Now, where do you set your stop-loss order? Well, a good rule of thumb is to place it just below the lowest low in the wedge pattern. This way, if the price unexpectedly drops, you'll limit your losses. As for the take-profit order, it's a little trickier. Ideally, you want to set it at a level that's equal to the height of the wedge, but projected upward from the point of the breakout. This is because, after a breakout, the price often moves the same distance as the height of the wedge. But remember, Forex trading is not an exact science. The price may not reach your take-profit level, or it may surpass it. It's always important to monitor the market and adjust your orders as needed. There's one more thing to bear in mind. As with any trading strategy, it's essential to practice good risk management. Don't risk more than a small percentage of your trading account on any single trade. This way, even if a trade doesn't go your way, you'll live to trade another day. Trading falling wedges isn't foolproof. Sometimes the price will break below the lower trend line, indicating a continuation of the downtrend. In such cases, your buy order won't be triggered, and you'll avoid a losing trade. As always, the key to successful trading is to use a combination of strategies and tools rather than relying on a single chart pattern. Falling wedges are just one tool in your Forex trading toolbox. With these steps, you are now equipped to trade falling wedge patterns. Now, let's turn our attention to rising wedges. These intriguing patterns are formed when price consolidates between upward sloping support and resistance lines. Imagine a wedge of cheese, but this one's made of numbers and lines on a chart. The slope of the support line is steeper than the resistance line, meaning higher lows are being formed faster than higher highs, hence creating a wedge-like formation. This chart pattern is named for its resemblance to a rising wedge. Now, you may be wondering, what does this pattern signify? Well, the consolidation of prices within this pattern hints at an upcoming big move, a breakout to either the top or bottom. A rising wedge can play two roles in the Forex market. If it forms after an uptrend, it typically signals a bearish reversal pattern, indicating a possible shift from an uptrend to a downtrend. On the flip side, if a rising wedge takes shape during a downtrend, it may signal a continuation of the down move. Here's where it gets exciting. When you spot this pattern, you have the opportunity to prepare your entry orders. For instance, in some situations, price action might form new highs, but at a slower pace than when price makes higher lows. This slowdown can be a cue for Forex traders that a downtrend may be on the horizon, with more traders keen to be short than long. However, it's not all about reversals. In some cases, a rising wedge can act as a bearish continuation signal. The price might come from a downtrend, consolidate, and sketch higher highs and even higher lows. If the price then breaks to the downside, the downtrend continues. This is why it's often referred to as a continuation signal. Just to recap, a rising wedge signals that a downtrend is looming. Whether it's a reversal from an uptrend or a continuation of a downtrend, the key takeaway is that a rising wedge is a bearish chart pattern. So, keep your eyes on the chart and your mind on the wedge. Ready to learn how to trade rising wedges? First, we need to identify a rising wedge on the chart. This pattern is formed when price consolidates between upward sloping support and resistance lines. The steeper slope of the support line indicates that higher lows are being formed faster than higher highs, leading to a wedge-like formation. Once we've spotted a rising wedge, we can anticipate a significant price movement or breakout to either the top or bottom. If the wedge forms after an uptrend, it's usually a bearish reversal pattern, signaling a potential downtrend. If it forms during a downtrend, it could signal a continuation of the down move. So, how do we trade this? Let's say we've identified a rising wedge during an uptrend. We can place a sell entry order at the level where the price breaks the lower trend line. This is because a breakout to the downside suggests a shift from buyers to sellers, indicating a potential downtrend. Now, let's talk about setting the stop loss and take profit levels. Your stop loss order should be placed slightly above the last high of the rising wedge. This is to protect your trade in case the price reverses and moves against your prediction. For the take profit level, a common technique is to measure the height of the wedge at its widest part and project that distance down from the point of the breakout. This gives you a rough target for where the price might go. Remember, trading is all about probabilities, not certainties. So, while a rising wedge often leads to a downtrend, it doesn't always. That's why it's crucial to manage your risk with stop-loss orders and not to risk more than a small percentage of your trading account on any single trade. With this knowledge, you can now confidently trade rising wedge patterns. Trading wedge chart patterns is not without its pitfalls. Want to know how to avoid common mistakes? Let's dive in. One of the most common mistakes is trading wedge patterns in isolation. Wedge patterns, like any other technical analysis tool, shouldn't be used alone. It's crucial to consider the overall market context and combine it with other technical indicators for confirmation. Another frequent error is misidentifying the pattern. Remember, a rising wedge forms when the price consolidates between upward sloping support and resistance lines, indicating a potential downward breakout. Conversely, a falling wedge indicates a potential upward breakout. Misinterpreting these patterns can lead to misguided trades. Impatience is another common pitfall. Traders often jump the gun and enter a trade before the breakout occurs. Remember, the breakout is your confirmation. Wait for it. Then there's the issue of unrealistic profit targets. The profit target for wedge patterns is typically the height of the pattern. Setting targets beyond this can lead to disappointment and unnecessary losses. And finally, not placing a stop loss. A stop loss is your insurance against massive losses. Always place a stop loss just outside the wedge pattern to protect your capital. So, how do you avoid these mistakes? Firstly, use wedge patterns in conjunction with other technical analysis tools for confirmation. Secondly, ensure you've correctly identified the pattern. If you're unsure, seek a second opinion or more education. Patience is key. Wait for the breakout before entering a trade. Set realistic profit targets and always place a stop loss. Remember, successful trading isn't just about making profitable trades. It's also about minimizing losses. And avoiding these common mistakes is a big step in that direction. By avoiding these common mistakes, you can increase your chances of successful trades. Before we wrap up, let's revisit the key points about trading wedge chart patterns. A wedge is a powerful tool in the world of Forex trading, signifying a pause in the current trend. This pause is your cue as a trader to prepare for the next big move. There are two types of wedges that we've explored: falling and rising. A falling wedge is a bullish chart pattern that occurs within an upward trend, its lines sloping down. When you spot a falling wedge, it's a signal that an uptrend may be on the horizon. It can serve as a reversal signal at the bottom of a downtrend or a continuation signal during an uptrend, indicating the upward price action is likely to resume. On the flip side, a rising wedge is a bearish chart pattern found within a downward trend, with its lines sloping up. A rising wedge can either signal a reversal after an uptrend, suggesting a potential downtrend, or it can indicate a continuation of the downward trend if it forms during a downtrend. The key to trading wedges effectively is being ready with your entry orders once you spot these patterns. Remember, the price movement after the breakout is typically similar to the height of the wedge formation. But trading isn't without its pitfalls. Mistakes can happen, especially if you're new to the game. One common error is jumping the gun, entering the trade before the breakout actually occurs. Patience is a virtue in Forex trading. Wait for the breakout to confirm the pattern before you make your move. Another mistake to avoid is neglecting to set a stop loss. The Forex market can be unpredictable, and a stop loss is your safety net, protecting you from significant losses. With these key points in mind, you are well on your way to mastering the art of trading wedge chart patterns in Forex. Keep practicing, stay patient, and remember, even the most experienced traders are always learning. That's all for today's lesson on trading wedge chart patterns in Forex. We dived deep into the world of wedge chart patterns, exploring both the rising and falling variations. These patterns, often seen as a pause in the current trend, signal that Forex traders are still deciding where to take the pair next. We learned how a falling wedge, typically seen as a bullish pattern, takes place within an upward trend. The trend lines slope downwards, signaling a potential uptrend in the near future. It's a crucial pattern to recognize as it can indicate a potential opportunity to buy. On the other hand, the rising wedge, generally seen as a bearish pattern, forms within a downward trend. The trend lines slope upwards, hinting at a possible downtrend on the horizon. This pattern can be a warning to sell or a signal to short. Both of these patterns can serve as either continuation or reversal signals, depending on their position within the larger market trend. This dual nature makes them incredibly flexible and valuable to traders of all experience levels. We also examined some common pitfalls when trading wedge patterns and shared strategies to avoid them. The key takeaway is not to jump the gun. Wait for the price to break out of the wedge pattern before making a trading decision. But remember, no pattern can guarantee a sure win. It's essential to use other forms of analysis to confirm your trading signals and manage your risk accordingly. As we wrap up, I encourage you to practice identifying these patterns in your Forex charts. Try to spot both falling and rising wedges, and see if you can predict the price breakout direction. Remember, these patterns can be your secret weapon in predicting future market trends. Remember, practice makes perfect, so get out there and start spotting those wedge chart patterns.